My name is Connie Kleinert, and I'm a second-year full-time MBA student and also a director of the Fink Investing Conference. We're about to start our Fireside chat, but first I wanted to introduce our speaker and our moderator. Our speaker, Hans Hufschmid, is the managing partner of AltB Partners. Prior to founding AltB Partners, Hans was a founder, chief executive officer, and member of the management committee of GlobeOp Financial Services from 2000 to 2012. Before founding GlobeOp, Hans was a principal at Long-Term Capital Management and co-head of its London office for 5 years. He also served on the firm's risk management and management committees. He previously spent 10 years with Salomon Brothers in London and New York, the last 4 as global head of foreign exchange sales and trading. Hans was a managing director and member of Salomon Brothers Credit Committee. Hans received a bachelor's degree in business from the University of Southern California and an MBA from UCLA Anderson. And our moderator is Dean Judy Olian, the 8th Dean of UCLA Anderson School of Management and the John E. Anderson Chair in Management. She began her appointment in January 2006, and under her leadership, Anderson has hired a record number of faculty and raised over $350 million for student and faculty support and to create innovative programming. She previously served as Dean and Professor of Management at the Smeal College of Business Administration at Pennsylvania State University, and Professor and Senior Associate Dean at the Smith School at the University of Maryland. Born and raised in Australia, she holds a bachelor's degree from the Hebrew University in Jerusalem, and she received her master's and her PhD from the University of Wisconsin at Madison. Thank you both so much for being here.
So I'm thrilled to be here with our friend Hans Hufschmid, and he's had a fascinating background, a global background, that started in Switzerland, where he was born, coming first to the United States to USC, and then took a trip across town and came to UCLA. So tell us why and how. Why did you make those moves, and what brought you to each place? Yeah,
it was all a bit unusual. And off the beaten track, I grew up in Switzerland. My dad was a baker, my mom was a waitress, and very middle class family. I had lots of cousins, and nobody went to university really. I did commercial studies in Switzerland, which is sort of you work 3 days, you go to school for 2 days. And then when I was 20 years old, really I wanted to go abroad to learn languages, and I went to England on my own to learn English, and ended up working there for a Swiss lady who had a travel agency, and I did the accounting for her. And so that's where I met my future wife, really, who was a graduate student at USC at the time. So she went back to the States to finish her second year, and I went to Paris for a year, and then applied to UCLA, actually, graduate school, and they told me that I was missing 64 units. So I applied to USC as a junior, and they told me that they would let me in as a second semester freshman, and so I did UCLA back to back in 4.5 years, and so that's sort of very roundabout way.
And married that person from USC.
Yeah, I did. Yeah.
Okay, so right out of UCLA, you were hired, I think, by an Anderson alum into Salomon.
Yeah, that's correct. So that was in 1985, and again, I knew very little about finance at the time. Actually, my interest was because it was the most difficult job to get. There were only, I think, in 85 class, there were probably 3 or 4 students that got hired by Wall Street, and it was also the best paying job. And so I was fortunate because that was at a time when these investment banks were all expanding internationally, and they were looking for US educated Europeans to ship them to London or Frankfurt, and so I got called back to New York with interviews for all the major investment banks, and then ended up accepting an offer from Salomon Brothers.
So you had a 10-year stint at Salomon and then moved to Long-Term Capital. Tell me, and in each case you ascended to very senior roles. Along the way you moved to London. Tell me what you took away from both of those experiences.
So Salomon was a very unique firm, and very different really at the time from a Goldman Sachs or a Morgan Stanley or a Merrill Lynch. It had an enormous risk appetite, for better or for worse, and But at the time, it was a competitive advantage, and he sort of had a no-frills attitude. It really suited my personality. I mean, I felt extremely comfortable there. It was a great place to work, and it was totally merit-based, which for me was much different from Switzerland, where you get a certain job if you're 30 years old, and you get another position when you're 35, another when you're 40. At Salomon, really, whether you're 27 or 45, it didn't matter. If you did the job, you got it. So I was there during a very turbulent time, and in 1991, Salomon got involved in this treasury scandal. I don't know how many of you know about that, but the head of the Treasury Department submitted bids on behalf of clients that were real in order to manipulate the Treasury auction process, and ultimately got caught, and it cost the leadership of Salomon and John Goodfriend, Tom Strauss. John Goodfriend was the then CEO, who's now passed away, Tom Strauss, and John Merriweather, who was really the head of risk management, all resigned as a result of that. And so I got promoted to global head of foreign exchange, and so moved back to New York and ran the FX department, which had been a very volatile department, making lots of money, losing lots of money. And so we sort of steadied it and made it one of the top earners of Salomon. And to me, the interesting thing there was really that we were running like a business within a business. I mean, we had our own risk management, we had our own compensation structure, we had our own cost structure. We obviously used the firm's credit lines to operate in the markets, but it was like running a business within a business.
And then John Merriweather lured you to join him and some others to create long-term capital. You got in there right at the beginning.
Almost, yeah. I mean, so that was probably one of the most difficult decisions I made. That's really, if I look back, that's really the only job I ever left, Salomon. And what happened is that, I mean, we were doing very well, and we had 45 people globally that sort of managed the risk, traded in FX, and it was just, great. I think we lost 2 people over the course of 4 years. So it was a very steady group. And in '93, JM started, John Merriweather started Long-Term Capital, and there were a lot of people who worked at the arbitrage group at Salomon, which really had been one of the major earners for the firm, major big risk takers too, that joined him. In addition to Bob Merton, who won a Nobel Prize in economics, Myron Scholes, who won a Nobel Prize in economics. We had David Mullins, who was the vice chairman of the Federal Reserve.
No shortage of credentialed people.
Yeah,
there.
very high quality people, and they started in February of '93, and really John wanted me to join, and then I just had a very hard time making a decision. But one of the things that happened at Salomon is, as a result, at Salomon you had this problem that you had all these different trading departments. So some departments would make a lot of money, and the guys got paid a lot. Other departments might lose money. So the firm might have made money or not made much money, but some people within the firm got paid tens of millions of dollars. And so it was a huge problem. And so post the Treasury scandal, I mean, Warren Buffett was our chairman for 3 years, right? And so he tried to implement a new compensation structure. And compensation on Wall Street is just an extremely tricky proposition. It is just a very difficult thing to get right. And so they came up with this model where, as opposed to being paid on your department's performance, the very senior people, you will get paid on the overall performance of the firm. And I just felt that, that was just not a good way to get paid. It didn't really matter to me whether I got paid more or less. It really mattered to me that I would get paid based on my own performance. And so here I was exposed to what the equity department in Tokyo would do, and I have absolutely no influence on them. And so I talked to Derek Maughan, who was our CEO at the time, saying that was going to be a huge problem for the firm. They were going to lose good people. And so, that sort of is the part, really that's the piece that sort of drove me over the line, and I accepted a job at Long Term. I mean, I was the last of 12 partners to join the firm, yeah.
So then Long Term had a crisis that really was affected the entire global financial market. So talk about that and what you learned, because you were right there at the epicenter.
Yeah, so the one thing you have to understand about long-term capital is that even though the fund started in February of '93, it had really been successfully run like that at Salomon since the maybe early 80s or so. So there was a lot of history there in terms of trading strategy, in terms of risk taking and how you took risk. And there's a great level of confidence that our way of looking at risk was the right way to look at risk. And so we had, we did extremely well. I mean, we had 50-60% returns in the first 3 years or so, 25% in '97, I believe. And we had these enormous positions, which by today's standards, when you look back, you sort of say that's crazy. But when you were in it at the time, it was just the same old, same old. In other words, we've been doing it this way for a long time, and successfully so. And so, when the crisis hit, which was really a liquidity crisis, in other words, we had all these positions and we couldn't liquidate them. On top of that, we've been so successful, everybody was copying us. So Goldman Sachs and Morgan Stanley and Salomon itself, by then it was Citibank, had the same positions, and they all started to liquidate. And really, we couldn't do much other than sit there and wait. And so we had $5 billion of capital, so we had return capital at the end of '97. We had returned $2 billion. So of the $5 billion, $3 billion was partners' capital, and $2 billion was outside capital. And then we had these enormous positions, swap positions that were in trillions of dollars. And I think one of the reasons the Federal Reserve got involved, I mean, they didn't get involved, they helped coordinate the rescue committee. It's because nobody really knew what kind of impact this would have on the market if we were to go down. And so, they invest the capital, they put in $3 or $4 billion, and then we started to unwind these positions over the next 4 or 5 months.
And so you were there till, in effect, the end in 1998?
Well, 1999. So I would say by May, I left in May of '99, so this started in August, September of '98, right? So by May of '99, our risk was essentially down to almost nothing.
And so then you decided, I want to be an entrepreneur.
Yeah, so the other thing I should say about long-term is that, lots of people have written articles and books have been written about long-term capital and what happened there. And, they in general got it right. But to me, I think one of the biggest parts about long-term capital was really, it was an organizational behavior study as opposed to a risk management study. Because I think the way we approach management at long term was responsible for a big part as to why we actually got ourselves into that situation. Because we had these 12 people on the management committee, about 6 or 7 of them were involved in trading the portfolios. 4 or 5 of them had really nothing to do with the portfolios, like Bob Merton, Myron Scholes, David Mullins, Dick Lay. Those were the 4 that really had nothing to do with the portfolio. So they had
yet they had a vote.
They had a vote, and they had input, and so Bob Merton is probably one of the smartest individuals I've ever met, and they could argue that a black table is green, right, very effectively, and so John Meriwether, who was the general partner, he tried to create consensus, and to me that was a big problem. Because on certain things we never reached consensus, because the partners that were not involved in trading had totally different objectives versus the partners that were involved in trading. As a small example, the partnership agreement, which we started negotiation in 1992, was not signed until 1997. So every week we would negotiate partnership agreement for 2 hours. It's crazy. And so I think that John should have just listened to everybody, taken taken, in whatever he learned, and then made a decision whether we should go left or right. So that was one of the problems. And then the other one is the position taking. I mean, when you trade at an investment bank, for instance, you have your own portfolio, and if you lose money, you feel that personally. I mean, it's painful. And you have to make a decision: do I want to sell? Do I want to buy more? Do I want to hold? And it is, ultimately it depends on your pain threshold and how clearly you can think when you're under pressure. When you do this with 12 people, nobody really feels responsible for a given position. I'll give you an example. We had a position in French bonds. We felt that the 30-year bond in France was cheap. So we kept buying that bond, probably in 93 or 94, and we kept adding to position, we kept adding position, we kept adding to position, and the way the yield curve was structured at the time is that you had negative carry on that trade. So you lost money every month, so you needed the 30-year to richen in order for you to make money. And we ended up owning 50% of the long bond in France, and it was still cheap. And nobody sat, we had lost $1 billion on this over the course of 3 years, and nobody sat there and said, hey, this is crazy, or no, this is way too painful. I mean, we had made so much money elsewhere that, but it didn't really stick out at the time. But it was to me, one of the major problems why we ran into.
So you've said, as a consequence, that one of the things you learned from long-term capital was that you have to be a bit of an autocrat when you are in an organization that you have to run. It would not work here, by the way, to be an autocrat, but I understand.
Well, what I mean by that, though, is not that you do what you want to do, but what I mean by that is really that you get everybody's opinion, and I think that if you ask people's opinion, and you give them a fair shot at expressing their view, and then you decide to go a different way, they'll accept that, grudgingly, but they'll accept it. I mean, a real autocrat wouldn't listen to anybody and just do what they want to do. So that's not what I'm advocating. But I think that ultimately, as a leader, you have to be the one who has to decide, after you've heard everything from everybody, whether you should go left or right.
So let's just talk about the window. So around May 1999, you disengaged after the whole workout of long-term capital. And by 2000, you had the entrepreneurial desire, and you were ready to take a leap in an area that really was totally unproven. You noticed an opportunity, a gap?
Yeah, so what had happened, I don't know whether I sat there and say, now I'm becoming an entrepreneur. It just sort of happened. But what happened is that we had the three individuals who ran the operations at long term. The accounting, operations, and technology came to me with a business proposal to set up a company that allowed hedge funds to outsource their accounting, valuations, risk management, stuff like that. And so it looked like a great idea to me.
To that point, it was mostly in-house managed.
Correct. That's right. And the other thing that happened is also at long term, I should say, is that one of the things that worked extremely well is the operational aspect. In other words, we had billions of dollars of positions, but we never missed a payment. We never had issues. We knew exactly what was where, no matter how complex the positions were. So we had a lot of know-how in terms of dealing with that. And that was actually a selling point for us at GlobeOp afterwards.
GlobeOp is the company that Hans founded.
Yeah, so when we started that in 2000, is that, hey, we've dealt in the most difficult environment operationally, so we know how to do this. And it got us a lot of, it got us to open a lot of doors for us. Yeah.
It established your credibility from early on.
Yeah. Plus people, they were very interested to learn what happened at long term, and the inside scoop and all this type of stuff. And so we got to talk to a lot of funds. Yeah.
Now, you have said that despite the crisis of long-term capital, that the early stage of establishing GlobeOp was the most stressful of your business career.
Yeah, it was very difficult. We had a, so it goes back to the Salomon day actually. Salomon had proprietary trading, was very well known for its proprietary trading. That then merged with Travelers, that then merged into Citibank. So Citibank had this proprietary trading group. That was the old Salomon group. And the guy who ran it is a guy who used to work for me at Salomon. And So Citibank wanted to take that off balance sheet and set up a separate fund. And so they hired us to do the middle back office. So that's how we got the first client, and that's how everything got rolling. And then we had 3-4 more clients, and but we were really fairly, low tech. It was, and the business was really, we were building the business at the same time as we were growing. So the analogy that I use, we were having our luggage running after a departing train, and people would throw more and more luggage at you, and it became more and more difficult to catch up. And so it was just extremely stressful because we had very unhappy clients. We had we grew so fast that we had to hire and hire and hire. And the first year we grew 100%. The first full year we grew 100% and 80% and 90%. And so we went from having 5 employees to having 120 employees in the first year. And it's very difficult to build a culture when you grow so fast, when you have to hire people from all of different places. Again, Salomon as an example, when I joined Salomon, they would never hire an outsider. They only hired people from universities. They came in, 6 months training program, and then they were indoctrinated and part of the cult. They would not hire somebody from Goldman Sachs, for instance. And so we tried to build a culture with having all these people from all these different backgrounds, and that was just very hard. And then unhappy clients, and so our employees would work, if I left the office at 10 o'clock at night, we still have 60% of the employees there. And that is not a good thing because it's not sustainable. So employees would leave. We had to hire new ones. We had to hire new ones because we had new clients. We had to hire new ones because we lost them. And so it was a mess for the first 3 years. Yeah, it was very tough.
And fast forward, you really built the GlobeOp to scale. By the time you sold it, you had 17 different locations. India had 1,500 people.
Yeah.
It was, what was the size of assets under administration?
So at that point, it was about 200 billion. But as in part, when you look at, when I look back at GlobeOp, there's certain decisions that we made that were just absolutely key. One of them, in 2003, we decided to go to India. And we had this woman who worked for us, who had worked for us at Salomon. She was a programmer. She was Indian, but had gone to college in the United States. She was 27 years old. She was very volatile. And, she'd scream and yell at people. And so we had to make this decision whether we should use somebody in India to get our foot in the door and then build our own. And I really didn't like that because I didn't feel like an outsourcer should outsource, right? And so we sent her back to India, and she helped us build this India operation. And so that was a big part because that allowed us to scale over time, because there we could hire 100 people in a month.
And it worked out with her disposition?
Yeah, she worked totally out. In New York, she was volatile, is the best way to describe it. Screaming and yelling, and the minute she goes back to India, she was,
right at home.
Right at home, and she calmed down, yeah.
Yeah.
And so that we had 3 big.
That's not a good selection model, I don't think. Yeah.
No, but that's the only choice at the time, And so anyway, so we had 1,800 employees in India by the time when we sold the business, and they were actually one of the things that we did that's sort of different from a JP Morgan, Citibank model or so, or a Citibank, India model. Is that our India employees were fully integrated in the process. In other words, we did everything in India that we did in London and New York. And what we used India for is sort of to move the work around the globe. So, when London closed, it went to New York, and then from New York, it went to India. And so India would do all these things overnight. And by the time London came in the morning, they would have P&L on their desk and reconciliations on their desk and all that stuff. So in order to do that efficiently, we had to build a technology infrastructure that allowed us to monitor every individual, no matter how small, every individual process for every client, and we could always tell what the status was of every single task.
Well, it's interesting how external factors often determine the direction of a business or have a big influence on it. And you talked about long-term capital and the general liquidity crisis in the market that affected everyone. So here at GlobeOp, you were actually helped by the Madoff crisis.
Yeah, that's true. So at the time, that was 2008, so at the time, a lot of funds would self-administer. So you give your money to a hedge fund, they do their own valuations, they tell you how much your investment is worth. And that's what Madoff did. He only did more than that, but that's part of the reason, he could do some of the things he did. And so post that, investors said, okay, no more self-administered funds. I mean, we have one huge fund in New York, it's a very successful fund, still, very successful fund today. And they came to us because their major investor was a Swiss private bank who had $1.5 billion or $2 billion invested with them, told them they were going to pull all the money if they continued to be self-administered. Right. So there was a tremendous amount of pressure on all of these funds to outsource the administration piece. I mean,
and get authentication and verification.
Correct, yeah. So independently verified P&L.
So, and I'm going to move on because I want to leave a few minutes for questions. But then you made a decision to sell?
Yeah, no, it was bought away from us. I mean, we went public in London in 2007, and we never got a proper valuation. I mean, we had a business that grew 20% top line, 30% bottom line, year in, year out, and we were trading at a 6 times EBITDA multiple, whereas our competition in New York was trading at 14 or 15 times EBITDA multiple. So we were we really tried very hard to increase the valuation, and it was just impossible. We had blue chip investors, they were all London based. It felt like they all met in the pub at night to discuss our valuation because nobody, would buy, even though it was very cheap, right? They wouldn't sell either, they would hold. And so we started a process to take the company private. Now in the UK, you have something called that there's the takeover panel. That's a committee, that's an independent committee in the UK, which has set up a set of rules that if you want to take your company private. And so there's 2 options you can go. You can go the public or the private way. The public way, you announce that you're going to take the company private, so everybody knows, the employees, the competitors, the clients. And then you can do whatever you want to do. You can talk to as many people as you do. You don't have to inform anybody anymore. But that's not a very good way to go, right? And then there's the private way where you can talk to 6 individuals at a time, and then you don't have to announce anything. So and that's the big but, if anything leaks, you have to put out a press release within 2 hours telling everybody who you're talking to and the valuation, and anybody who is interested after that can get access to your data room and see everything that you've shown everybody else. So we went through this process, we went down, we had 2 finalists, Texas Pacific and Advent, the 2 major private equity houses. And we wanted to go with the private equity house because we would have reinvested our own proceeds into the new company. Anyway, so January 3rd or 4th, as we were actually out here in California, it leaked, and we got a call from a news channel in London that they were going to talk about this, and so we had to put out a press release. And so there's this other company in the US called SS&C Technologies who'd been wanting to buy us since 2001, and so the guy saw it, and he insisted that we give him a presentation, which we had to do by law, and then he bid 11% higher than TPG. And so, our investors obviously were going to get out, so they wanted to get out at the highest price.
And I can tell you at the time, Hans, you were not happy.
No, because I told him, I said, if he bought us, that I was going to leave, then that all the management was going to leave. And it's going to be a disaster for him, it's going to be a disaster for the clients, it's going to be a disaster for the employees. And he said, I don't care. So.
And he's done fine.
And he's done very well, yeah.
So then the last piece of the chapter is that, again, Hans did another entrepreneurial gig in AltB.
Yeah, so that was not very successful. I mean, we made a little bit of money, but we did not really accomplish what we wanted to accomplish. We had this, you just listened to a discussion about active and passive investing. I'm a big believer in passive investing, and one component when you passively invest is that you don't have is sort of a hedge fund exposure. And so we wanted to put together an index that was made up of the best hedge funds that you can, just, and for very low fee, where you can get your hedge fund exposure at one place.
And you would essentially bypass the hedge fund fees.
Well, no, the hedge fund fees are still there, right? Because they're embedded, so you can't get rid of those. But our fees were going to be very low, yeah. And so, but we were never really able to raise institutional money, and then we ended up selling the software.
Let me ask you just a couple of contextual questions, and then we can take a couple of questions from the audience. You've been involved in financial markets in both London and New York in particular. What's the difference as an entrepreneur, as a banking executive in both marketplaces? Is one more conducive to entrepreneurship, to business than the other?
I'm not sure. I mean, they both have red tape and stuff like that. It's very minimal in both places, really. I mean, compared to India, for instance. I mean, we wanted to do an IPO initially, actually, in the United States in 2005, and then I really felt very uncomfortable about the regulatory environment in the United States. You had CEOs that went to jail for things that they couldn't control or had no responsibility for. And London, to me, had a much more pragmatic regulatory environment, and that's why we did the IPO in London. But then, as I just said, the valuation in the US would have been much better.
Right. Mm. And the sales process would have been very different.
Yeah, very. Yeah.
And any thoughts on how Brexit is going to affect the City of London as a financial epicenter?
I don't know. I mean, as somebody see it, it's going to be. Well, there's a lot of uncertainty. So that's the biggest thing, and nobody knows whether Brexit's going to work out or not. So the uncertainty is the part that creates all this commotion right now. And there's a lot of talk about this hard Brexit. And in Europe, you have this concept called passporting, that if you're regulated in one country, you can passport that regulation to all the other EU countries. And they're talking about getting away from that for the UK, which I think would be a huge problem. I mean, in the UK, the Square Mile, which is the financial district in London, pays 13% of the taxes. So it's a big chunk of UK government revenues, and I think they have to be very, very careful not to mess with that.
And is it your sense that there's some uncertainty presently pervading those markets? You've got elections coming up in both the UK and France.
Yeah, so
and of course, we have 100 days here almost.
Yeah.
And it hasn't exactly been clear what's happening.
Right. I mean, these elections, the UK election, I think everybody assumes it's going to be a huge Tory victory. In France, I mean, all the other parties are now behind Macron. So
you don't see uncertainty there?
I don't think, no, because the market is up 250 points today, because they really felt, this whole, because in France, you did have this possibility that you had a far right and a far left candidate in the runoff. And that would have been a disaster. But now that Macron is in there, that they expect him to win, I think it's 20% plus ahead.
Right. So maybe one last question from me, and then if you have questions, there are microphones there. If you were a student today, sitting there, and let's say you took one of the great finance tracks at UCLA, Anderson, where would you position yourself today? Where do you see the opportunities? And there's a lot happening. In passive, active, fintech?
Right. I mean, it's very hard to say, to be quite honest. The students probably know better because they see what's hot and what's not. That was certainly the case when I was here. Even though I knew nothing about finance, I knew it was very hot. But I think that sort of the golden age for what I've done, which is on the trading side, that's sort of gone. I mean, there were real opportunities to make very, very low risk money in trading. And I think.
And why is that gone?
Well, it's the information age. You have the information advantage.
It's an equalizer.
It's a huge equalizer. So I would think in proprietary trading, where you take risk positions, the people that really have an advantage still are probably the investment banks, because they see the trade flow, and that's very valuable. Hedge fund doesn't see that. It's very difficult.
Any questions, please?
My question relates to your belief or your shift towards passive investing. We obviously just heard a pretty vigorous debate for the last hour and a half in the last session. And my question is, is it strictly because you think the information advantage has been diminished to the point that that active no longer has the opportunity to outperform, or is it more from the perspective that that most people are better suited to sort of the low fee index product?
Yeah, so there's a couple of components. Actually, I have a question for you to answer before you sit down. The one is that the fee, to overcome the fee the fee charge, is just very difficult. I mean, I saw this study almost a year ago, 2 years ago, where they looked at active managers versus an index, and they looked at over a 15-year period, and over that entire time period, 16% of the active managers outperformed S&P or whatever the index was. And every one of those managers in that 16% pool underperformed for a period of 5 years in that 15-year period. So not only did you have to pick the right guy at the beginning, you had to stick with them during a time when they were not doing so well. So I just find, I mean, the odds are just so against you. I'm not saying they're not there. And then there's this other example, and the friend of mine who I work with actually long-term passively manages money. I mean, he does asset allocation, but once he's determined where to allocate the assets, it's all passively managed. He came up with this question of, if you have two coins, one is 50-50 coin, and the other one is a 60-40 coin, how many times do you have to flip the coins until you have a 95% confidence interval certainty that you pick the 60-40 coins? I mean, what would your answer be to that? How many times do you think you need to flip it?
30 times.
30 times. It's 143 times. So think about this. Okay, I mean, that's a lot of time before you know with certainty that somebody is 60-40 versus somebody who's 50-50. And so that's just another hurdle in picking a great active manager. I'm sure they're out there for periods of time, but in the long run, and I'm saying long run, 50 years or whatever, past my or our lifetime, it's just a very difficult thing to do.
Somebody who's associated with long-term capital management talked about positions as feeling when you lose money and having ownership of positions, which seems kind of contrary to the LTCM mathematical arbitrage. So I was wondering if you could talk about, the kind of trade-offs there and how somebody moves from mathematical arbitrage on the one hand to feeling and to the kind of trader's instinct on the other. So
it's a good question. I mean, that's the whole point. We didn't have this. We looked at mathematical arbitrage, and some of this stuff was not mathematical arbitrage. It was, I mean, if swap spreads, for instance, we were short swap spreads at 60 basis points at the time, and we felt that the equilibrium swap spread was 32 basis points. So we would go short at 35 basis points because we thought the equilibrium swap spread was 32 basis points. So it was purely model based. And the example I gave with the French position is that nobody sat there and said, hold on a second, our model tells us that this bond is X, 20, 30 basis points cheap, but we now own half the issue and it's still 20 or 30 basis points cheap. So there's something else going on that we don't understand. And I think in terms of relative value fixed income trading, that was one of the big changes after 98, where people said, even though I think swap spreads are wide at, or at 40 or 50 basis points, I'm not going to short them because I think they go up first before they go down.
Could I just ask a follow-up? Is that, we see a lot of quant strategies, kind of in a rebirth actually, based on mathematical arbitrage or models. Do you think they're informed by some of that trader intuition that you're talking about, or does that concern you that we have, money that's not?
I think those are different strategies. I mean, that's sort of algorithm trading where, I mean, you have these mathematical models because if something, they try to extract very, very small a very, very small arbitrage by trading lots and lots of stock. I mean, what we did was really, we positioned this stuff and we sat with it forever. To give you an example, in the mid-late 80s, some of the futures were trading in Europe and in Japan were extremely cheap. And so you could lock in 1 point per 3 months, virtually risk-free. Not 100% risk, but virtually risk-free. And we would have hundreds and hundreds of millions of billions of dollars of positions on there, because Salomon did not care if they lost $100 million mark to market if they knew, that this was really going to come back. Whereas at the time, and that was the competitive advantage of Salomon at the time, Goldman Sachs and Morgan Stanley and all these other guys would not take that kind of exposure. And so for that's what we then carried into long term. And then obviously at some point, one of the things that we didn't consider is that if you get a liquidity squeeze and you can't do anything, then you run out of capital, and that's what happened to us.
I'll ask maybe just the final question, because I like to ask this. You and Jane, your wife, were very generous to UCLA Anderson, and you said, we have the Hans Hufschmid chair sitting right here in Roman Varshyard. You said that Anderson had an impact on your career. In what way?
Well, it played a major part in my education. I mean, it's it's sort of where I got very interested in finance. Obviously, one of the major jobs of a graduate school, in my view, is the issue to education is to place the students in good jobs, and he did that for me. So, I was very fortunate, really. I mean, I don't consider myself better than others, or there was a lot of fortunate things that happened to me. I was at the right place at the right time, and so I was very happy to give back.
Well, thank you, Hans. Thank you, everyone, for being here. Thanks, Jane. And we're moving on to the next session. Thank you.